Today I want to look at the weekly charts and I want to answer the question, if the bear market returns, how are we going to know by following price action? As you likely know on this channel, we follow price action over everything else because price action is king, and today I'm going to show you exactly why that's the case. Alright, so the first thing we need to do is go back and look at the bear market of 2022, and we need to identify the market structure of the price action that told us that was a downtrend within a bear market. So the first thing we noticed is that we started to see price action impulsively breaking down below this weekly 20 simple moving average. And from that breakdown, we started to see the market put in these lower highs and then breaking down into lower lows. And the price action continued to confirm a downtrend on this weekly chart. Eventually, we bounced from this 414 zone and we came back up to this negatively sloping weekly 20 simple moving average. And the first sign we were likely rolling over was the fact that we went from a positively sloping weekly 20 simple moving average to now a negatively sloping weekly 20 simple moving average. From that negatively sloping moving average, we then went and put in another lower high from the previous all-time high and eventually came down and put in another lower low on a price action breakdown. And we continued to see price action flushing to lower prices. And about that time in June is when we confirmed that we were in a bear market. So we're defining a bear market as any market that draws down 20% or more from the all-time high, and any market that is currently putting in lower highs and lower lows is also going to be considered a bear trend. So once we have the confirmation of the bear market, surely lots of people panic sold their positions just in time for a very face-ripping counter-trend bear market relief rally. And that is exactly why you never want to panic sell your positions, because once we were confirmed into the bear market, we actually saw a very impulsive bull rally. However, it was still a bear market, so we're expecting to see lower highs and lower lows. And once again, we came down from a lower high and put in another lower low. However, this time, we did not go much lower than the previous low because we found support at the rising 200 simple moving average on the weekly chart. And I consider any market above a rising 200 simple moving average on a weekly chart still a secular bull market. This is a very slow moving average, and as you can see, it still has a very positive slope. And price action found support at that level and is now bouncing and continuing into a bull trend. So even though last year was an obvious bear market, which is very evident by what we just went over by looking at the price action of lower highs and lower lows with that negatively sloping weekly 20 simple moving average, it is very clear that we are no longer in that bear market, because now if we just stop looking at the left side of the screen and we only start looking at the right side of the screen, we can very clearly see that when we bounced off the weekly 200 simple moving average, the S&P 500 has only been putting in higher lows and higher highs, which is evident by the price action. So if you only look in the rearview mirror and you continue to think this is a bear market, you are ignoring all of the new data we have on the chart to the right side of the screen, which is telling us that we're currently in a bull market. So we'll use the same exact logic we just used to talk about the bear market, and we're now going to use that same logic and apply it to the bull market. So the price action bounced off the rising weekly 200 simple moving average. We had a very impulsive break above the weekly 20 simple moving average, and that told us we were getting high volume buying and we were breaking critical resistance. And then we had a rejection from this resistance, came down and put in a higher low from the previous low where we bounced off the rising 200 simple moving average, and then we bounced and broke the resistance trend line from the bear market and put in a higher high breakout. So if we just look at this price action very simply, we can see that on that breakout of that higher high, once we had the pullback, it was into another higher low, and then we proceeded to break out to another higher high. And now we can look at the weekly 20 simple moving average and we can see that rollover effect from a negative slope into a positive slope, which tells us the market was reverting from a downtrend back into an uptrend. So we now can see from the price action, we are still making higher highs and higher lows, and we just had another breakout to a higher high when we had the break above 427. So if you strictly look at the price action, it's very objective to say that this is a bull market. And if you're saying it's not a bull market, you're using recency bias from the bear market of last year. There is no way looking at this chart based on everything we just went over that it's anything other than a bull market. However, that doesn't guarantee it has to stay in a bull market. So we just objectively defined why this is a bull market. And if you want to use another rule, we are over 20% off of the lows, which means if you retrace 20% off of the lows and you break this resistance right around the 61.8% retracement, typically speaking, you are no longer in a bear market. And you can do that back test on your own and you can go look at all other bear markets. Once you retrace more than 20% off of the low, typically speaking, you are only going to put in higher lows from there and the bottom is in. Now let's just play devil's advocate and let's say the bottom is not in And we are still saying that the bears are thinking this over here is going to be a lower high, and we're going to come crashing back down and continue into the bear market, and we're going to go put in a lower low. First of all, it is subjective to assume this is going to happen. There is nothing on the chart that says this is going to happen. So if you're assuming this is going to happen, it is simply an idea, and there is no factual evidence that this is going to occur until we get the price action that confirms it, which is exactly what I want to spend some time going over with you today. So if we are going back into a bear market and we're going to assume this is going to be some type of lower high eventually, we are eventually going to see price action putting in lower highs and lower lows. We are going to see price action breaking down below the rising 20 weekly moving average, and eventually we're going to bounce back up to that level. We are going to see that moving average roll over and start to die as price action continues to crash back down. And there is going to be very objective evidence on the chart that the price action is telling us something else is happening, and we're continuing back into a downtrend. So the only way we're going to know that's going to happen is objectively following the price action, because we're going to start to see price action putting in these lower highs and lower lows, and we're instantly going to know that we're likely ending the bull trend and going back into a bear trend, because the price action gives you instant information. There's no lagging indicators when you're following price action, because you know exactly when that candle closes, whether or not it was a higher low into a higher high to confirm a bull trend, or a lower high into another lower low to confirm the bear trend. So quite simply said, we are not going to know if the bear market is back until we start to see price action do exactly what I just drew here. And as you can tell, looking at the x-axis on the chart, that takes us all the way out into August of this year and then later. So we're not going to know the bull trend is ending until the price action proves it. That's why I say it's a bull trend until it's not, because the price action has already done all of the talking, and the price action is very clearly bullish, which tells us we need to stay on this bull as long as it continues to put in higher lows and higher highs. So that means even if, in theory, price action pulled all the way down to SPY 414, that is where we would be looking for another higher low into the next higher high that could take us to 450 or higher. This is exactly what the chart is already telling us, and I'm not saying we need to go down to 414. Any higher low will suffice, and we don't even need to go down to the 20 simple moving average. We could find support right here, right around 427. And remember, this is a weekly chart, and this is not just candlesticks that are moving day to day. This takes a full week before we get a candle close. But if we do find support right around 427, it is possible on this weekly chart we're trying to get to 450. So it's a bull trend until it's not. We need price action to prove otherwise. And if we continue to put in higher lows and higher highs and get these bull breakouts, we could go back all the way up to retest the previous all-time high on a break above 450, which would take us up to the previous all-time high around 475. So that's why it's very important to let the price action in the chart do all of the talking. And I'm going to show you next, if we just look at the bear bull survey, we are starting to get a lot more bulls on the survey who are now saying in the next 6 months they think the stock market is going to be higher. And this goes back to my saying that nothing changes sentiment faster than price. You could see 1 year ago, the bearish high was over 60% of the people that were still bearish, which is extremely high. And I talked about that a lot last year. And I even showed you this chart from macro charts, where when we historically get that low and we have that many bears on the bear bull spread, that is typically going to associate with a market bottom. And that usually means the bear market is very close to the end. So if you look at this chart, that is the condition we had last year in 2022. And this is going back 35 years of data. It also correctly identified the bottom in 2009, and it also correctly identified the bottom in 1990s. So as you're seeing from this data, when everybody starts to become bearish, they start to assume the market can only go lower, and that is usually the best time to start buying stocks and holding them for the long term, which is very evident on this chart. So as bulls start to step into this market, we are going to see this sentiment shift, which is exactly what we're seeing on this chart. But as you can see from the chart, when we're going from overly bearish sentiment to bullish sentiment once again, that is typically associated with higher lows and higher highs as the chart continues to march higher. And that is what is going to associate a bull market and not a bear market, is that you continue to put in higher lows and then break out to new higher highs. That's what gives us that uptrending market that we're so accustomed to seeing, because as you know, over long periods of time, the S&P 500 typically goes higher, and decade over decade, it has been a great investment. So I'm not really interested in investing, and typically we're more traders on this channel, but it is important when we're following price action, we understand that just because everybody is bearish does not mean that we should join that camp and become bearish with them. Typically the majority are going to be wrong, which is very evident on this chart. And when we go back over to the S&P 500, we can see that did correctly mark the bottom last year as we got that double bottom look, and now we're breaking out above SPY 427. So I think there's a good chance in the short term we are going to put in some type of higher low and continue towards 450. And that is likely going to take us out through the rest of summer, because we could continue this pullback all the way into July, eventually find support and put in that higher low, and then start back into the bull run after August or September. Now, if you just look at this chart to the right side of the screen, if we get a pullback all the way down to 414, that still gives us plenty of time in the year to start marching higher towards the previous all-time high, which could take us all the way out towards the end of the year. And if you just look at this market structure, you could easily see how this could be the case as we pull back down towards that rising weekly 20 simple moving average, put in that higher low between 414 and 427, and then continue that breakout to another higher high and march higher. The only way we're going to know that the bear market is back is if we start to put in lower highs, and then we break down and put in lower lows, and then we come back down towards this rising 200 simple moving average, and then eventually break down through it and continue back down towards 350. That is going to significantly open the door to the possibility of breaking the October lows and going back into that secular bear market. So above the rising 200 weekly moving average is a secular bull market, but if we start to get this price action of lower highs and lower lows, and we break down to lower lows and below the rising 200 weekly simple moving average, then it is possible we go into a secular bear market, and this could mark the lower high of the bear market as we continue to lower prices. So as I continue to tell you, we are currently in a bull trend, which is a bull market, which means it is a bull market until it's not. So don't bother guessing that we're going back into the bear market. Just wait for price action to prove it. And if we get that lower high into the lower low, we will instantly become bearish because the price action is going to command us to. That's the definition of following price action and letting the price action do all the talking, and checking your bias at the door. If we get the price action that confirms the breakdown and the bear trend, we instantly become more bearish because we don't have a bias and we couldn't care less whether the market's going higher or lower because we're traders. Our job as traders is not to force our will upon the market. It is simply to follow the current trend and identify what the chart is telling us. And right now the chart is still telling us to remain bullish. So we'll give all of the benefit and the odds to the bull trend until price action tells us not to, and that is how we're going to continue to manage risk and do very well in this market. We are absolutely crushing this market in Bank Trade Alerts and the Stocks Channel Discord server. So if you need help in this market or you're looking for a community to trade with, consider joining the Stocks Channel Discord server or Bank Trade Alerts. You can find out more information about both of those services and find out how to join by clicking on the links in the description of this video. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.